Welcome to the monthly fixed income outlook for the month of September. In the month of August, we had two key economic events. One was GST rate cut announcement by the Government of India, and the second was additional 25% tariff by US. Now these two events have different impact as far as growth is concerned. GST definitely is supportive for growth, whereas tariffs have a negative implication as far as sentiment and exports are concerned. The way we look at the economy at present is RBI cut rates by 100 basis points and then the government stepped in by doing the GST cuts. We think both these steps should help the economy recover, and we think that the economy is on a recovery path. However, if the implication of tariffs has an impact of growth, we think that RBI will chip in and we'll see more monetary policy action from RBI. As far as the market is concerned, we saw a sell-off in long bond yields as well as SDLs. We saw that as an opportunity to come back to the bond market, and therefore we released a tactical note on our Gilt Fund. The idea behind the note is that bond yields have now gone to a level where they are now close to a peak which they saw in the last cycle. For example, the 30-year bond 5-year forward is now trading at 7.90%. It peaked in the last cycle at 8%. So we see this as an opportunity. The risk of the fiscal deficit slippage in the market is overblown. In our assessment, there won't be any major impact from GST on the fiscal deficit. Maybe next year we get a 20 basis impact. But the way the market has reacted, I clearly think that market is far ahead of where the growth inflation dynamics are. And that effectively has opened this room to invest in the Gilt Fund category. Apart from the Gilt Fund, we also like the dynamic duration category, and also the short-term bond fund, the corporate bond fund, and the Banking PSU Bond Fund category. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.